So today's Monday morning mortgage update is going to be uh, obviously going over rates, but also some secrets of mortgage insurance. There's a lot of people that don't really understand the different types of mortgage insurance and how you can really structure a buyer's transaction to have the lowest possible payment with different options on mortgage insurance. So I'm going to go over that today as well. But first off, let's jump right into the morning or the mortgage update as far as what rates are doing, because rates are, well, they're kind of stuck, and it's a good thing, I guess. They're stuck because we don't really know what's going to happen in the Middle East with Iran. It's kind of a mixed bag. The markets are trying to predict it, but every time they try to predict it, they get it wrong. So this is kind of where we're at, but actually, it's actually a little bit more stable now. Here's a little breakdown of where we've seen mortgage-backed securities. So we saw a big run down, and rates got their worst when they hit down here, but then we have seen a rebound. And if you look at last Wednesday, we actually saw a really big move all the way up to the 100-day moving average and then stuck there. And then, because this was when they announced the Strait of Hormuz was opening. So it was big move upward. And then all of a sudden they said, just kidding. And Iran said, heck no. And then some more bombs flew, and then we lost it all. I actually locked in quite a few of our customers right at that peak. So we locked in on a good day because then we lost a lot. Right when the markets started turning around, we have about an hour to an hour and a half as lenders to lock in rates before it hits the rate sheet. So we got the benefit, and then we locked in, and then the markets lost their shorts. Well, we rebounded a little bit the next day, and now we're kind of stuck in this range right here. So we're going to just see what the markets play out this week and really see what this really it comes down to the Strait of Hormuz. Right now, there's a blockade on it. The United States is blocking it. So there's a lot of posturing back and forth here. It's really an interesting economical impact as well because this is a global thing. It's actually more global than it is directly affecting the United States, but because it's such a global impact, everything gets hit. I mean, our mortgage-backed securities are purchased by other countries, our treasuries are purchased by other countries. So their inflation hurts our inflation. And inflation actually numbers were really bad when they came out on last week. So a lot worse than expected. But the markets kind of took it in stride because they knew it was only based on oil. Everything else was pretty tame. So once this oil thing gets figured out, mortgage rates will get better. Here's the 10-year. I'm not liking the trend because we're above this Fibonacci level here at the 38.2%, the 4.332 level, which means we could probably go higher here. So I'm really watching that carefully. Um, so we'll see what happens. Again, the Strait of Hormuz, everything that happens there is going to have an impact on what mortgage rates do moving forward. So here's where we're at. We're in the mid sixes, about 6.4 on a 30-year. Most of the rates we're locking right now do come with seller paid rate buy downs. So we are seeing a majority of the transactions we're working on do have seller credits to help buy the rates down into the fives. So that's a good thing. But as you can see, rates are kind of stubborn. We really want them to be in the fives across the board with no cost, but like FHA is there, VA is a little bit is there, but again, that's with the perfect FHA borrower, and most borrowers on FHA come in a little lower on the credit score, hence the reason they choose FHA. But let's look at kind of what's happening this week. It's a light week. We have some ADP numbers coming out tomorrow. We've got some PPI, the producer price index. That's going to be interesting to see that inflation reading. And then we have the manufacturing index on Wednesday, the Fed's beige book. So that's going to be interesting to see on Wednesday as well. And then the jobless claims coming out on Thursday. That is always a market mover. So I'm going to be watching rates really carefully. Hopefully, this thing in the Strait of Hormuz will open up and we'll see things come back to normal, normal trading, that is, and it's not all over the map with something that we can't predict. Watching trends and watching how the economy works is actually really easy to predict what mortgage rates are doing. But with wars like this and with the oil being squeezed, so to speak, on its distribution across the United States and I'm sorry, across the globe, it's really, really hard to predict. So we just want to be cautious and make sure our customers understand that. Now, the secrets of mortgage insurance. Now, not a lot of people understand this. Mortgage insurance. Now, when I'm talking about mortgage insurance in this aspect, I'm talking about conventional loans only. I will go over FHA for a little bit, but I want to take away, I want you guys to walk away with some real good understanding of how mortgage insurance works, the different types of mortgage insurance. Yes, there are different types, and how to structure our buyers to have the lowest possible payment. So here we go. So first off, I want to talk about how mortgage insurance is removed, because a lot of people think once it hits 78% of your value, it just automatically drops off. That is partly true, but it's 78% of the original home value, not the value at the time. So let's just say you bought it for 400,000 and your house went up to 470,000. It won't automatically drop off when it hits 78% of the new value of the 470 or whatever it's going to. It'll fall off automatically when it hits 78% of the original home value at the time of the purchase. A lot of people don't really understand that piece. It's very important. It's based on the original home value when you did the loan and the original amortization schedule. So that's when it drops off automatically. If it takes too long to do that, it will fall off at the midpoint of the loan at the 15-year mark, but never earlier unless it hits 78% of the original home value. So if values drop, that could be a problem, but if they go up, if they scream upwards, it's still not going to remove it. Now you can remove mortgage insurance with an appraisal. You can get an appraisal sent in and then do it that way. It takes some time. It's not an easy process, but it is a way of getting your mortgage insurance removed if you're not just waiting on it automatically to come off. So the automatic waiting period, 78% of the original home value, and it will fall off. If you want to get it taken out, if your appreciation has gone way up, the only way to get it removed quicker is to get an appraisal, send it in. And again, the appraisal has to be ordered through the servicer. But you call them, say you want to order an appraisal and get that sent in. They will take it off that way manually, but automatically 78% of the original home value. So some mortgage insurance is permanent. FHA mortgage insurance is permanent. But I want to talk to you about ways with a conventional loan, ways to get around mortgage insurance, because there's multiple different types of mortgage insurance. All of us understand the monthly payment for mortgage insurance. And that's what this is. Now, this is a calculator that we have internally because we have access to all of the mortgage insurance companies. When what we put in the details of mortgage insurance, it spits out a monthly, if you can see over here on the left, a monthly version of what it's going to cost for this person's mortgage insurance. And it gives me all of the different mortgage insurance companies. It gives me the top 6. There's a lot more. Now this one for them is cheap because they had really good credit. It's 0.19% annually or $57.63 a month for this monthly mortgage insurance. But I want you to look at the top here. See where it says split buy down, single premium, lender paid? We're going to focus on these 4: monthly, split buy down, single premium, and lender paid. These other 2 don't really have to do with anything, but these are the 4 different styles of mortgage insurance. The split buy down is where you can pay, and I'm going to go to it right now. You can pay a fee of $3,600, 1%, and then your mortgage insurance drops to a significantly less amount. So this one, it goes down to $9 a month. Now, sometimes this is a great option. Sometimes this is actually not a good option. And we'll look at that. We'll look at them side by side. But you can basically buy out a majority of it. Now, this one takes it down to $9 a month. That's super cheap. $3,600 to do so in this scenario. That's if you do a split buy down. So you can make it cheaper per month and you can pay an upfront premium to cover most of it. Or you can do my favorite piece, which is the single premium. Notice with this person, it's actually cheaper to buy the whole thing out. It's $2,839 to buy out the mortgage insurance. You pay a one-time fee and there's no monthly mortgage insurance payment. Now, a lot of people say, well, who can pay for this? Well, you can have the sellers pay for this. You can ask and have the sellers' concessions cover this so there's no monthly mortgage insurance. Now, this is a secret sauce that I use if you have a debt to income ratio issue on a conventional loan and they're putting less than 20% down, we can pay off the mortgage insurance to eliminate the payment to help with debt to income to help qualify or to qualify for more. So this is a great tool. Notice there's a lot of different mortgage companies here, mortgage insurance companies here. It's a great tool to lower the debt to income ratio to qualify or to lower the overall payment associated with the mortgage overall. So single premium, that's what that is. Now the next one is lender paid. That is where the mortgage insurance is built into the rate. And this is where it gets a little bit more convoluted, but in reality, it's 1.25% cost in points to get this. So what we do as a lender, we look at a rate that doesn't cost anything and we go up in rate until there's a credit of 1.25% to the borrower. Keep in mind the way that rates work, there's a sweet spot where the rate doesn't cost anything. And as you go lower, it gets more expensive. There's also, if there's sweet spot where it doesn't cost anything, if you go higher, the higher you go, the more money you actually get to pay for closing costs. In this circumstance, it would be 1.25%. So you could go higher in rate to get that cost so that the rate itself covers the mortgage insurance. So there's no monthly mortgage insurance, but your rate is higher. Don't really recommend this one right now because we're already in a high interest rate environment, but it is another option that you may not have known about. So that's called lender paid. It's the mortgage insurance is built into the rate itself. There's no monthly mortgage insurance. It's all built into the rate. This could be cheaper than having a monthly mortgage insurance payment. Even though it's a higher rate, it could be cheaper per month. So just an option. We look at all of them side by side to see what's going to be the best overall for the customer. And again, this is only on conventional loans. Conventional loans are the only ones that have this flexibility. But it is a great, great tool to really figure out what options your customer has, the buyer has, to try to have the cheapest payment possible. Most people, the push button get mortgage people, will never show you the customers this, not even close. They will never present this. So another benefit of dealing with a mortgage professional is we know the secrets. So FHA versus conventional, there are some differences, and I want to go over those real quick. So FHA loans are better for people with lower credit score. Conventional loans, the mortgage insurance can be very expensive. The lower your credit score, the higher the risk. So conventional loans, the private mortgage insurance is more expensive. You can take a screenshot of this if you want, but mortgage insurance for conventional loans, if you have really good credit scores, is very cheap. As an example, if you go back to the previous slides that I showed, I'm going to show you this real fast. The mortgage insurance factor on the monthly was 0.19% on this conventional loan. That's really low. And the reason I say it's really low is if you look at FHA, FHA is 0.55% for everyone. So if you have a first-time home buyer and they're thinking FHA is probably the best loan for a first-time home buyer, not always. A loan with 3% down or 5% down could get you could have lower mortgage insurance on a conventional loan if your credit score is really high. But if your credit score is really low, that factor could go up to, instead of 0.55 on FHA, you'd be at like a 1.5% on a conventional. Your mortgage insurance could be triple on a conventional loan compared to an FHA. So we look at the costs of the mortgage insurance when we're looking at customers. That's why most borrowers, they go FHA when they have lower credit scores, because the mortgage insurance factors for conventional loans with a 620 credit score are ridiculous. They're very expensive. FHA is very cheap per month. So it's easier to qualify for an FHA loan if you have a lower credit score because it's cheaper overall for the mortgage insurance. So some big differences, but FHA, the mortgage insurance is permanent. It's for the life of the loan. It will never drop off unless you refinance. So if you refinance, you have the opportunity to remove mortgage insurance with both of these, as long as you go back into a conventional loan. But mortgage insurance is one of those unknown, like mysterious things, and it's not that difficult to understand once you know the secrets, so to speak, of the mortgage insurance. So I'm not sure if you have any questions on this, but if you do have any mortgage insurance questions, now's the time to jump in and ask. Let me make sure you guys can all speak. I'm taking everyone off mute. So if you have some questions on mortgage insurance, speak up, and I'm here to answer those.
Sean, how does the mortgage insurance work on a jumbo loan?
Good question. Almost all jumbo products have mortgage insurance that's built into the rate. So there are some that allow, there's some mortgage insurance companies that do follow suit and will insure jumbo loans. So the same type of rules, but a lot of the good jumbo loans, you'll see a little bit higher rate on them. When you're doing less than 20% down, you may see a little bit higher rate, and that means that mortgage insurance is built into that rate. Or you may see a lower rate, but they require one of these mortgage insurance companies to step up. And they do. These mortgage insurance companies, they do have options for jumbo loans as well. And it will always act the same as a conventional loan. But you'll see majority of them don't have mortgage insurance. It's built into the rate.
Thank you.
Good question. Any other questions on mortgage insurance? All right. Well, if you do come across questions and you have any customers that are asking you about it, send them my way. I'm happy to help them. Or you can answer them now since you have the knowledge and the secrets. But there's a lot more behind the scenes when it comes to mortgage insurance. This is really the meat and potatoes of the secrets. But there's so much more that I could go over with you. But this is really the gist of it and the most important pieces of it so that you can move forward with confidence. But hope you guys have a wonderful week. It's a beautiful Monday. We may actually get some rain today. So enjoy your weather, enjoy the week. And if you need anything, I'm always just a phone call away. So thanks, guys.